Alright, this is an update on the S&P 500. I'm going to go through a number of charts here. The first thing I'm going to go over is the technical analysis on the stock market averages here. So this first chart is the S&P 500. It's a weekly chart. This is the 2009 bear market low there. This is a MACD study right here. This is a ADX line here, so this shows directional movement or trending type of movement. And the way to use these two together is if the MACD is going up and the ADX is going up, that's confirming a trend. If the MACD is going down and the ADX is going up, that's also confirming a trend. So anytime this ADX line here is rising, that means the market is going into in a trending mode, and then the direction to MACD would say whether that's a downtrend or an uptrend. So what we saw in the last bear market was as of about June of 2008, the MACD here turned down, and the ADX here came above the 20 line and turned up, and then we basically had a downward trending move to about here, at which point it started to flatten out and create some divergence there, and it ended. After that, the MACD turned up here, but the ADX turned down, so there's kind of a non-trending type of move, at least based on the indicator. Obviously, it was a really strong price move there. And then you went through some sideways trading here. As of here, a wee little uptrend there, a bit of a downtrend there, and then the ADX turned down here, so a non-trending period, and then it turned up here into an uptrend, and then another non-trend period, kind of sideways with price, and then as of last summer in July, it turned up again, and the MACD turned down again, so we had a downtrend. Since the October low, the MACD has been going up, the ADX is going down again, so it's been a non-trending or counter-trend move. Now, that doesn't necessarily mean the next move will be down, the next trend will be down, but the fact that it is moving up but in a downtrend mode would at least set the stage for now this ADX to start to turn up if this MACD rolls over, and set the stage for a downtrend or a stronger trending move to the downside. On a daily chart, this is the S&P 500 still. On last Friday, the averages closed outside their Bollinger Band, and in recent months, over the last year or so, when it's closed outside the band, it usually hasn't gone very many days before a correction. So I actually think we're going to see excuse me, some further correction into this coming week here at a minimum, if not more there. Down here you see a stochastic study, and even though price moved higher, stochastics didn't move a lot higher, so there might be some mild bearish divergence on that. There is a bearish cross as of here yesterday, Friday. The way I would use this is not automatically sell this, but if the market makes a lower low than Friday's low, that's what some people call a trailing one bar low. Sell signal. So you wait for the cross, but sometimes, if you look back through these charts, like right here, at this day, there was a cross, but the price never came down to make a lower low. And if you always trade as soon as you get the cross, you can get many whipsaws, especially if you're trading counter trends. So you want to at least wait for that, and that increases your probability. So that's the strategy I'm going to use this week, is to do that. Why will I do that? Why will I take that counter trend trade? Basically because the weekly chart here, the stochastics is overbought, and it's overbought at a lower high relative to the last time it was overbought here last summer or last spring. So there is at least initial indication there may be a downtrend. It's overbought at a lower high. It's been overbought for several weeks here. Let's actually look at this for a second. And then if you look at the stochastics here, the numbers on it, the fast line, the %K line, actually is lower than the %D line right now. So that's even in a sell type of configuration. So if we get a lower low of this week's low, that could be a weekly trailing one bar low sell signal. So we have kind of multiple time frames that are giving us the same information here. We're not just trying to catch one tiny wave and a bigger wave the other way. We're trying to catch a really big wave that's timed really well on multiple levels there. Another thing I wanted to point out is the MACD. Let's look at that on the Dow. So here's the October high, and the MACD got up to this level here. Now, after this following correction and this rally, the MACD has not come up above that level. So there's a bearish divergence there. It isn't a real pretty one, but it's objective. You can see it. And then I think even more importantly than that for the short term, as of the last week of January, the MACD came up to this level here, and despite the market moving up to higher highs, the MACD hasn't. So you have a little bit of bearish divergence between price here and the MACD here. How far will this go? I think we should probably see a correction down to this level, even if the market continues a bit higher here. But one thing I'm going to talk about is the chart pattern here, is it might be set up for a larger decline. I'm going to click over to the weekly chart on this too. And even though the Dow has now made a couple points higher high relative to the May high, the MACD is way below that. So on a weekly chart, there's a pretty strong bearish divergence. However, I don't really like the looks of it. I don't necessarily call it a bearish divergence in this situation. I like divergences like this one where it goes up, there's a cross down, and it doesn't go all the way below the zero line before coming back up and crossing down again. So there's more of a shallow thing. And then this divergence is a real nice looking divergence. Same with this one here. It crosses up, comes down, so there's a real nice divergence. This one came all the way down here and crossed up, so it had some time to get oversold there. So I don't know if that's significant, but it is objective as far as the divergence there. This chart is the NASDAQ composite, and it has an ADX study in here. So again, the ADX is showing trending type of moves. It's a way to measure that. And 40, if the ADX rises to 40, that's generally regarded as a trend that has fully developed a very lengthy trend. We see it's at 45 now. If you look at it, it's higher than it's been at any time in the last few years. So this trend right here since mid-December is really developed. We can't really expect this indicator to go much higher than that. Does that mean price can't go any higher? No, it doesn't mean that. And when we saw the ADX kind of peak out down here in 2010 and still go up for another month, we saw that kind of happen in here. The ADX peaked out, and then it started to chop around more instead of move real tightly, but it did continue to rise. So that doesn't mean it's topping right here, but there is a possibility that this is a very extended trend, and we are seeing the market put in some form of top here. This is S&P 500 again. This has a 50-day moving average, 200-day moving average. We did just see a cross here over the last couple weeks, and when that's happened in the past, a lot of times there's a whipsaw. So we saw it cross right in around here, and my experience would say the market will often create kind of a whipsaw type move where it'll move back to around the level or below the level where the cross was. And I think that functions to flush out weak hands, weak holders, dumb money, whatever you want to call it, before moves continue. So even if this continues in a bull market type fashion, I kind of expect there to be a move back down here on that basis as well. I'm going to look at the Russell 2000 here. There's some interesting stuff. One thing I haven't really talked about before either. This labeling is just a standard Elliott wave labeling here, so that's what the numbers and letters mean there. Here's the interesting thing. First off, between this high here, the reaction high off of the kind of mini crash low here, between that high and the trend line connecting that October high, the market has just come up and exceeded that. And on rising wedge type of patterns, that's really the target. If you see the market overshoot that upper boundary line, a lot of times you're right at the end of the pattern, and there may be a really strong move down after that. Now, there's also something called a Wolf wave, which doesn't have anything to do with Elliott wave. It's a way to look at market patterns, and while that I'm not really an expert on that, the way they would count this is as a 0.1, 2, 3, 4, 5, and they look for 5 to overshoot the 1 to 3 trend line, which it did right here, and then the target would be the 1 to 0.4 trend line. So this trend line here, and the time frame on that is that price move should happen by the convergence of this trend line and this one here, which I have marked with this vertical line here. So that seems like a really big move. I don't know if that's going to come, but the pattern is real nice. It's real geometric there. And this first leg up off the low was almost an exact 0.618 retracement. This one has overshot the 0.786, the ideal Gartley pattern, but the pattern's still pretty nice there. We actually see some stronger divergence, bearish divergence on the Russell here. We had a pretty big gap up, which might be an exhaustion gap. We've had already confirmed sell signal on the daily stochastics. So if I go to short the market or trade inverse to the market, I'm probably going to look to do that on the Russell 2000. This is the New York Stock Exchange chart, and what I want to show on this chart is there's a really nice, pretty doji candlestick right here that formed on Thursday. And the doji in and of itself, after a long uptrend, can be significant. However, it's a lot more significant if you have confirmation the following day in the form of a large bar down with a low close, which we basically did have on Friday there. So while I would rather see this market correct a little bit and push up to a little higher high to create some better bearish divergence within this wave here, we could be, this could be the top here based on this candlestick pattern. So one of the things I wanted to go over is the shorter term technicals too. Here's the hourly chart of SPY. Here's a MACD, here's the stochastics. The MACD has been staying basically above zero for since December, since it broke out of this level here. And now we've had a divergence where the MACD is coming down, price is still wedging up a little bit, kind of overlapping, and we saw a gap down on Friday there. So what I think will probably happen is we should see the market come back down into these levels. The MACD should actually get oversold, maybe something like this before any type of move up there, if it does move back up. So that's shorter term what I'm looking for there. There's an unfilled gap at this level that could be used as a target price. Also, you could look for price to actually undercut this swing low a little bit, and then kind of gauge any reversal at that point as well. This is the Dow daily chart, so the cash Dow, not the DIA ETF, and this is the big 2010 advance there, topped on May 2nd, and then what we've seen is over the last 3 to 4 days, price has come up to that level but hasn't been able to break down through it. So there's potentially a double chart top pattern forming here on the Dow, which would be pretty bearish pattern, seen as a true double top chart pattern. The measuring for the projection is to take from the low of the neckline and the high of the double top and project that down from below, project that down from this low. So that would be a really big move down if that's the case. So I don't know if that's the case, but that's something to look for here. As far as the price logic, I did want to go over that. I have some labels on here. Basically, what I believe is happening here is what might be called a triple three in Elliott wave terms, up off of the 2009 loan. So we had a bear market, and one of the things I always go over, I talk about moves that retrace the prior move faster than they took to form. So we had this move down where you had downward moves, slower upwards moves that didn't retrace the whole upward move. So a series of lower lows, lower highs, and then even this move off the low didn't retrace this move faster than it took to form. But after this little correction here, that move did. So what I think is happening here is an upward move, higher lows, and then this move came down and completely retraced that faster than it took to form. So we have a correction of that. So you call that a W, an X, and then another upward move here, and then a larger, faster move, completely traced it. So WXY, and then another X pattern, and then we should be in the third and final phase of a large complex correction here. And where will that end? How long will that take? I think the best way is to use the technical indicators as a guide there, and use any indication from the smart money as far as what they're doing as an indication there. But we've basically been close to 5 months up, 4 months or so up off of this low here, and we've probably already seen an A, B, and working on a C type of move up here. So we could get another correction and an advance to form a D and E type of thing, but it might top here. And if that happens, the projection would be very bearish, because we should see an initial downward reaction. Once this large pattern completes, we should see a downward reaction larger and faster than any of the downward reactions in this pattern. So we should actually see a move even bigger than this decline we saw in the summer. We should see a move bigger than we saw surrounding a flash crash. We should see a move on par with or bigger than what we saw in January 2008. So if and when this completes and this is happening, we should see a very large move down based off of that pattern. So I'll continue to update that. The initial way to confirm when the pattern is complete is to take the most recent wave up, and let's just say it's from this B label here in mid-December, 1, 2, 3, 4, 5, 6, 7 weeks now. The first move off the end of the pattern should completely retrace the prior wave up in less time than it took to form. So at a minimum, to get some confirmation that there has been a pattern completed, we would need to see this wave here retrace faster than it took to form. So I'll track that as the coming weeks go by. Now, one thing I showed, a few details of data I showed this past fall on the blog. One was this chart, and these dotted blue lines on this chart are all the bear market rallies from the 2000 to 2002 bear market and the 2007 to 2009 bear market. So in price and time, and I projected them all up from the October low to give us an idea of where a bear market rally should end, how long it should take, how far it should go, and that type of stuff. This green line is the average of them all. So we've obviously surpassed the average in time, because we're in a third of the way through February here. We've surpassed the average price because we're up here around 1340 right in here. Now, there was only one bear market rally that took longer than our market is currently taking, and that was in one of the major ones in the 2000 to 2002 bear market, before it really started down into the final phases of that bear market. So the S&P 500 has not made a new high relative to the May high yet. So this still could be termed as a bear market rally if it tops and moves to lower lows compared to October. So if that's the case, it's getting stretched it's right towards the end of the time frame that we should see that happen. So we could be seeing a top in this level here. One of the other charts I showed is this one right here, which showed a typical bear market rally with this green dashed line, an average bear market leg down, and this red line. And again, and these are from the previous two bear markets. And then this blue line here is a average historical bull market leg up in price and time. And so the average time is a little bit less than 5 months on a typical bull market leg up, and the average price is maybe 25%. We're up here around 1340 in early February, so we've overshot the average price a little bit. So and we've taken significantly longer than the average bear market rally. So this move is really behaving more like a bull market leg up, and I think that fits with the pattern in that the psychology. I don't know if that 333 type of pattern has completed yet. We may still be rounding out or working on a topping pattern of a large upward correction off the previous bear market low. So in any case, even with the bull market pattern, the average time would put us in late February. So we should be getting in that area where we're looking for sell signals, we're looking for divergences, and we're gonna act on those. This red line is the average bear market leg down. So if we are in a bear market, if you use that line to project down from wherever price is now, you can see it's a pretty big move down. And that would basically mean that market continues to make lower lows without a 1 month counter trend move there. So that's what I mean by a bear market leg down. This is a chart of the McClellan oscillator. So this measures breadth and kind of smooths or averages it. I really like this indicator for tracking breadth as opposed to just using raw advanced decline data. But there are some divergences starting to show up, which might be significant enough to make this an intermediate high. I know the price of the S&P isn't on here, but we just had highs this past week, but the McClellan oscillator didn't make a high relative to the last week of January there. So we had some bearish divergence. Also, the McClellan oscillator didn't make a high higher than the October high. I don't really think that's that significant because you will see these big spikes in breadth coming off of significant lows. So I don't know that that's significant, but the uptrend line from here to here has now been broken by the McClellan oscillator, and there's bearish divergence. So I think we'll probably continue to see at least a brief correction here over the next week or so, even if the market does turn higher after that. This is a chart I use of the daily closing tick data, and then this blue line there is a 5 period moving average. The way I like to use this is to look for the tick to form an extreme or a divergence, which we have seen here. The market's continued higher here, and the tick has put in some lower highs here. And then when that 5 period average crosses the 0 line, looking back through charts, a lot of times that's indicated that we've seen a high on a move, and there will be a bit of a correction of that. Here's the VIX with some Bollinger Bands. It closed below the lower Bollinger Band a few weeks ago there, and oftentimes you see that, and the market will correct not long afterwards there. So the VIX spiked up a bit on Friday. It broke the trend line from this mid-December to February. Downtrend in the VIX and uptrend in stocks there. Touched the upper Bollinger Band, so hey, maybe the VIX is now ready to decline again. However, it could be an indication that we're starting on either a sideways range before the VIX moves up, or the VIX could go on and break up above the upper Bollinger Band and lead to a spike in the VIX like that. There's another way I use the VIX I haven't talked about in quite a while on the blog, but is to count the number of lower lows or higher highs in a trend. And whenever you see a trend make 12 to 15 lower lows or higher highs in the VIX, there's often a turning point there. And we were basically from the November low down to here. there were 14 if you count this day, or 15 if you count this day, even though they had the I guess this was technically the low there, so 14 lower lows in the VIX. So that puts you in a sweet spot for a reversal on the VIX there. This is something I showed before on the blog too, looking at the advancing issues minus declining issues on the New York Stock Exchange. And this blue line here is a 10-day moving average. The green lines and red lines are extremes and minor extremes. And if you look back over the last couple years, when the 10-day moving average has come above the 750 level, that's typically where it's topped out. And then if you see some divergence after that, that's a good sign that breadth is starting to wane a bit. There's not as broad a participation. The market's weakening, and then when the 10-day moving average crosses zero, that's been a pretty good indicator that you may have seen a high. So what I like to see is an extreme, and then that blue line cross zero. We haven't seen that yet. Another day or two of downward move may cross that zero line, but these other red lines show times where the signal basically happens. So pretty good signals there for some corrections. That one spiked up a little bit before it corrected. Here we're right around those highs. That was a good signal. That was a pretty good signal. So I think we should at least see a minor, relatively short-term correction, if not a significant intermediate-term high like we've seen at some of those before. So that kind of wraps it up on the technical analysis there. Gone over some of the patterns there. As far as what the smart money is doing, in mid-January, the Dow showed that the commercial hedgers were, the momentum of the COT data was saying that they were selling, and I'll get some more data on that this weekend and maybe pass some of that along. But the smart money has been selling here. The open interest on this move up since October has not been typical of the expansion of open interest on an up leg in a bull market, which may indicate it's primarily a short covering going on and not really new buying. So I don't know that that's a healthy, longer term bull market pattern there. It's significantly weaker than is typical, and it's also basically creating a type of bearish divergence if you look at the open interest there. So we have some indications there that they are also getting ready for a top here. My suggestion is to take sell signals at these levels. Make sure you use stops above the highs, but the Russell looks to me to be the weak one right now. The Nasdaq is definitely the strong one right now. So you'd probably want to look at the Russell. The New York Stock Exchange and energy or commodity related issues, I think, are also kind of weak ones. I didn't show the CRB index in here, but the CRB index which is a commodity index, has rallied along with stocks here, except as stocks were able to push to higher highs here over the last few weeks. The CRB index corrected a little more heavily and then has made a lower high. So there's also some non-confirmation on the CRB index, and which would indicate that commodity-related stock issues may be leading to the downside here. So I would look either at the Russell 2000 inverse ETFs or commodity-related companies or ETFs potentially to take advantage if you're looking to trade inverse to the market. I'm going to touch on one last thing, and then I'll wrap it up for this update here. I know it's been a little bit of a long one, but I think the market is potentially at a very significant turning point, or at least very close to that, over the coming weeks or possibly coming months here. So I did want to show a lot of data as far as what I'm looking at, a lot of indicators, so you get a broad picture of that. The last thing I want to touch on is, if this is a continuing bull market, what a correction would look like. And I've already shown what a leg up should look like, 4 to 5 months, 24 24-25%. We've already overshot that 24-25% a little bit. We're basically at a little over 4 months right now. So we're right in that time frame for a normal leg up in a bull market to top what is a typical correction in a bull market look